Investments and Wealth Institute shared this great article by Dr. Wade Pfau, and I wanted to share the pertinent insights with you. My goal is to highlight the strategies, the mechanics, and the big picture insights you can put to work with your clients or in your own planning. If you've ever heard reverse mortgages described as expensive, risky, or a last resort, what you'll hear today will challenge that thinking. Reverse mortgages, specifically the home equity conversion mortgage, or HECM, let a homeowner borrow against their home without making a monthly mortgage payment. The loan is repaid later, typically when the borrower moves, sells, or passes away. For decades, the conversation around these loans was dominated by myths. The costs are too high, the home will be taken away, only desperate people use them. But the truth is the opposite. With HUD and FHA tightening and refining the rules over the years, protecting non-borrowing spouses, checking for financial stability, ensuring counseling, HECMs have become a strategic liquidity tool for retirement planning. What most people don't realize is that reverse mortgages can increase flexibility, improve spending sustainability, and even increase the size of the legacy left to heirs. Dr. Pfau reframes the entire topic with a simple but powerful question. If retirees have both an investment portfolio and substantial home equity, how do you coordinate those two assets to meet spending needs while reducing risk and preserving legacy? Traditionally, homeowners say, spend the investments first, save the home for last. But Dr. Pfau shows why that creates inefficiency. Every dollar you spend from a portfolio or from home equity reduces what's left for future spending and legacy. Where most people go wrong is assuming spending home equity shrinks legacy, spending investments doesn't. In reality, both have opportunity costs. So the question becomes, how do you coordinate the two to create the smoothest, safest, most efficient retirement income? Here's where Dr. Pfau flips the narrative. Waiting to use home equity until the portfolio runs out of money actually produces worse outcomes in most scenarios. Starting a HECM early, even if you don't touch the money right away, creates two big strategic advantages. The 5 years prior and the first 5 years after retirement have been dubbed the fragile decade. Market declines early in retirement are the number one threat to portfolio survivability. If you retire at the wrong moment, a 20% drop can permanently damage your withdrawal rate. A reverse mortgage gives you a buffer asset, a second spigot to pull from during down markets. So instead of selling depressed assets, you press pause and let the portfolio recover. Remove the constraint, change the math. This feature is widely misunderstood and one of the most powerful wealth tools in retirement, which is the line of credit that grows. The unused portion of a HECM's line of credit grows every year at the same effective rate the loan balance would grow. Translated, if you open a HECM at 62 and never touch it, your available line of credit keeps expanding, sometimes dramatically. This growth is contractually guaranteed. It's not tied to home values, and it's not revocable. In long retirements, it could be possible the line of credit grows larger than the home value itself. That's when the non-recourse feature becomes extremely valuable. Line of credit, loan balance, and principal limit all grow at the same effective rate, and voluntary payments can re-expand the line of credit. Dr. Pfau goes into 4 different strategic use cases. The first one is housing and debt coordination. You can use a HECM to finance aging-in-place renovations, refinance an existing mortgage, which can remove a fixed obligation that stresses the portfolio, or buy a home in retirement via a HECM for purchase to right-size your retirement home. You might want to move closer to family, downsize into a condo, or perhaps even upsize to have more room for extended family. Scenario 2 is portfolio coordination for spending. Use a HECM to reduce withdrawal pressure on investments, skip withdrawals in down markets, avoid selling investments in bear markets, improve portfolio longevity. Scenario 3, efficiency improvements in retirement planning. Use a HECM as a bridge to delay starting Social Security, as an alternative to income annuities via 10-year payments. Proceeds from the credit line are not taxable income since they are ultimately a loan against the asset. That can help with strategic Roth conversions, as well as tax planning as part of withdrawal strategy. You can use it to fund long-term care premiums and other income-soothing strategies. His fourth scenario in the article is preserving the line of credit as insurance. Treat the upfront cost as an insurance premium for a future liquidity pool, protection from declining home values, in-home care funding, divorce equity splits, an emergency pool, and this final category is where the option value becomes enormous. Non-recourse protection is a powerful aspect of a HECM. The borrower never owes more than the home's value. Title stays in the borrower's name. Heirs can either pay off the loan, refinance it, or sell the home and keep the difference. If the loan ever exceeds the home value, FHA insurance absorbs the loss. Dr. Pfau's central message is clear. Reverse mortgages are no longer fringe tools. They're mainstream retirement income architecture. Used proactively, not as a last resort, they can improve cash flow flexibility, reduce sequence of returns risk, support higher sustainable spending, increase longevity of the portfolio, and surprisingly increase the total legacy left to the heirs. Home equity is simply another asset. Coordinated correctly, it makes retirement more resilient. If you'd like to see how a HECM would work into a plan for you or a client, please reach out.